Hi students, welcome back. We are continuing with Accounting Standard 10, Property, Plant and Equipment, PPE. And this is part 3 of our series. In this session, we will begin with an important topic, subsequent cost. Subsequent cost. What are subsequent costs? Once a property, plant and equipment asset is ready for use, that is capitalized and brought to its intended working condition, any further cost incurred after this point is called subsequent cost. This may include repairs and maintenance, replacement of parts, major overhauls, additions or modifications, and inspection costs. Should we capitalize these costs or expense it? This is the crux of the issue in Accounting Standard 10. According to Accounting Standard 10, a subsequent cost is capitalized or added to the assets carrying amount only if both the basic conditions are met. Follow. What are the basic conditions? It is probable that the future economic benefits associated with the item will flow to the enterprise, and the cost can be measured reliably. Otherwise, expense it off in the profit and loss account in period in which it is incurred. That's all. Example for better understanding. Number one, day-to-day repairs. These are revenue in nature. Purchase, oil change, fixing a leak, repairing a machine. What is the purpose of all this? Just to maintain the asset in normal working condition. And now the treatment. Expense it off. Why? No increase in future economic benefits. Just maintaining status quo. That's why. Okay. Next one. Major overhaul or replacement of a part. Example. Replacing an engine in a truck after 5 years. What's the purpose? Increase efficiency or life. Now, what's the treatment? Capitalize. Provided it meets the two conditions, the basic conditions we know already. What are these? It is probable that future economic benefits or perhaps associated with the item will flow to the enterprise. And the second condition, the cost can be measured reliably. Okay. So, why capitalize? Increases efficiency or life means it enhances assets capacity or extends useful life. However, please note that if all part was previously capitalized, remove its carrying amount from the books. This is de-recognizing and capitalize the new part. Okay. Next one, inspection costs at regular intervals. For example, aircraft or heavy machinery requiring mandatory inspection every 3 years and treatments. Capitalize if inspection cost is significant and future inspections will lead to future benefits. Here also, if previous inspection cost was capitalized, should be de-recognized when the new inspection upgrades. Okay. Fourth one, modification or upgradation. Example, installing pollution control equipment, automation systems. Now the treatment. Capitalize only if it leads to increased capacity, reduced operating costs, or leads to extended lives. Okay. So let us conclude that always check whether the expenditure improves the condition of the asset beyond its originally as a standard. If yes, capitalize. Otherwise, expense it off. When in doubt, just ask, does this cost enhance the future economic benefit, that is called FEB, or is it just to maintain the asset? And decide accordingly. Next is component accounting. AS10 mandates component accounting, which is particularly relevant where parts of an asset have different useful lives or patterns of benefits. Now, why component accounting? We enhance accuracy in depreciation. It will ensure faithful representation of PP's consumption of economic benefits. Most importantly, it's required especially for complex assets like aircraft, ships, power plants, refineries, etc. Next, what's the definition of component accounting? Component accounting means recognizing each significant part of an item of PP separately if it has a cost significant in relation to the total cost of the item. I repeat, if it has a cost significant in relation to the total cost of the item and it has a different useful life or pattern of depreciation. I repeat, and it has a different useful life or pattern of depreciation. Well, let us take an aircraft as an illustrative example. An airline buys an aircraft for rupees 50 crore. The major components are airframe, cost being 35 crores and useful life 20 years. Engine, 10 crores cost and useful life 10 years. Interior, cost 5 crores and useful life 5 years. Well, each component must be capitalized separately and depreciated over its own useful life. We have seen each has got a different useful life, is it not? When the engine is replaced after 10 years, what is going to happen? De-recognize old engine, rupees 10 crore, fully depreciated. Capitalize the new engine at its replacement cost. That's all. Let us now examine what AS10 says about the recognition criteria of components. Recognition criteria. Well, we have basically learned that an item of PPE should be recognized as an asset if probable future economic benefits associated with the item will flow to the enterprise. And the cost can be measured reliably. Well, this applies equally to individual components also. Now let us check when component accounting is mandated. First of all, when the cost of a component is significant. Thereafter, when the component has a materially different useful life. I repeat, when the component has a materially different useful life. Therefore, materiality and judgment play a role. Not every part needs to be accounted for separately. Only significant components. Okay. Now, Account Standard 10 versus Schedule 2 of the Companies Act. Both require component accounting. Schedule 2 of the Companies Act 2013 says, useful life shall be determined for significant components if they have a different useful life than the asset as a whole. I repeat, useful life shall be determined for significant components if they have a different useful life than the asset as a whole. This reinforces the requirement of Accounting Standard 10. Well, now what are the challenges in practice? Identification of components, estimation of individual useful lives, tracking component level costs, and of course, de-recognition of replaced components. Well, summarize component accounting. Identify major components since it matters for accurate depreciation, capitalize separately since it matters for real value, depreciate individually, will ensure we base on the useful life. And finally, when a component is to be replaced, de-recognize the old component, thereby avoid overstating of assets. Well, now let's learn about subsequent measurement on the balance sheet as far as measurement of PP is concerned. We know that PP is initially recognized at cost. Well, thereafter, an enterprise must choose one of the two models, that is cost model or revaluation model for subsequent measurement. I repeat, cost model or revaluation model for subsequent measurements. And the same will be reflected in the balance sheet. Please note that. By default, it will be cost model. Now, the definition of the cost model is that PPE is carried at its cost less accumulated depreciation and impairment loss, if any. Key features of this model are that it is simple to reflect. no change in asset value unless impaired. Depreciation continues on historical cost and no revaluation reserve arises. Now, what about revaluation method? First of all, keep it in mind that revaluation method is an optional method. And the definition of revaluation method is that property, plant, and equipment is carried at revalued amount, being fair value at revaluation date less subsequent depreciation and impairment loss. I repeat, and the definition of revaluation method is that PP is carried at revalued amount, being fair value at revaluation date less subsequent depreciation and impairment loss. Well, key features are it reflects fair value of assets. Revaluation must be regular. Upward revaluation means revaluation reserve will be credited and downward revaluation means profit and loss account will be debited. Of course, unless reserves exist for adjustment. Now, basis of valuation under cost model is historical cost, whereas under revaluation method, it is fair value. Cost model is simple, whereas revaluation model is complex and costly. Depreciation under cost model is on historical cost, and under revaluation model, depreciation is on revalued amount. Please don't forget, once a model is chosen, it must be consistently applied to the entire class of PPE. Well, a small illustrative example, let us take up. Example, comparison of cost and revaluation model. Let's take a scenario. XYZ Limited purchases a building on 1st April 2020 for rupees 10 lakhs. Useful life 10 years and straight line method is a lump of depreciation and no residual value also. Revaluation done on 1st April 2023, fair value being 13 lakhs. Well, in the cost model, annual depreciation will be 1 lakh. You will agree with me? 10 lakhs divided by 10 years, straight line method. Fine. After 3 years, that is till 31st March 2023, accumulated depreciation will be 3 lakhs. That is 1 lakh into 3, just like that. Carrying amount on 1st April 23, how much? 7 lakhs. 10 lakhs minus accumulated depreciation of 3 lakhs. Continue depreciation 1 lakh annually. Is it not? Because it's SLM. I've just taken a break here carrying amount because revaluation has been done. That's why that 7 lakhs figure I arrived at. You will understand it. In the revaluation model, carrying amount before revaluation, we have just arrived it as rupees 7 lakhs. That will be one and the same. Revalued amount, what is that? 13 lakhs has been given. Yes, that's the revalued amount. Revalued surplus, how much? 13 minus 7, 6 lakhs. That will be transferred to revaluation reserve. Now, what will be new annual depreciation? The 30 lakhs divided by the remaining 7 years. That will be rupees 1,85,714 per year. So please find the difference. Here it was 1 lakh, continuing depreciation 1 lakh, whereas now it will be 1,85,714 per year. Got it? Well, now why might a company prefer the revaluation method? Number one, reflect true and market value. Revaluation brings asset value closer to current market prices. This gives a more accurate and fair representation of a company's financial position. Number two, improved borrowing capacity. Revalued assets increase total asset base and net worth. A stronger balance sheet can improve loan eligibility and credit rating. And third one, enhanced investor confidence. A revalued asset shows financial transparency. Investors may have more trust in a company with updated and realistic asset valuations. Fourth one, better depreciation matching. Depreciation is calculated on the revalued amount, aligning expense recognition with asset utility and fair value. I repeat, depreciation is calculated under this method on the revalued amount, aligning expenses recognition with asset utility and fair value. This helps in more accurate profit measurement. And the fifth and the last one, compliance with international trends. Probably many entities, especially under IFRS, use fair value accounting. Adapting revaluation may help multinational companies or those planning to list globally to align with the global practices. Okay. But there are drawbacks. Companies must also consider revaluation gains go to revaluation reserve, not profit and loss. Revaluation must be done regularly, which increases cost. Example, professional valuation. Further, revaluation can introduce volatility in the financials if asset value fluctuates. Well, students, that's the end of this video. Catch you soon. Take care of yourself. Till then, bye.